Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
On this episode, Trishul and Aaron discuss cost basis, which is typically the purchase price from which a taxable gain is calculated. But it's not that simple, given all the extra adjustments you might need to make on your tax return. Commissions, fees, capital gain distributions, reinvested dividends, and stock splits are just some of the things that can impact your cost basis. By tracking your cost basis at the tax lot level, you might even lower your taxes. FIFO and LIFO are often used as a default, but both may land you with a higher tax bill. Finally, there's tax loss harvesting, which can be an effective strategy to save money over market cycles. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Last week, we talked about some of the guesses that we've seen with the Biden tax proposal. And one of the things that came up was the potential elimination of the step up in basis. And kind of that's just a quick phrase, like it's the your cost basis would increase to the current value upon death. Another thing I've been thinking about over the last few weeks is around this time, end of February, beginning of March, I'll ask to take a look at my clients' 1099s, especially for those with company stock who had either stock options or RSU transactions last year, because there can be, especially around IPOs, a lot of kind of changes in companies doing the reporting. Sometimes there can be mistakes in how the basis is reported. It's usually not the case that the transactions get reported incorrectly, although that can happen. But seeing mistakes on the basis can happen a little more often. There's also different requirements for how different custodians need to report basis. It's not necessarily required on the 1099, but it's usually seen in a supplemental information to the 1099 to help you with your tax return. And kind of think about this, like the fact that cost basis came up twice in a few completely different topics. Trish and I wanted to explore kind of everything cost basis. So we're going to try and help you understand why you need to understand it, what are the implications of taking a look at certain identifying and specific characteristics of cost basis. We'll start off on stocks and just kind of really make sure you understand the mechanics of why you need to know your cost basis. And Trish and I put together a pretty quick list of a lot of things that basis comes into play. We'll see if we can fit it all in one episode, but we might even go 2 episodes on this one. So Trish, you want to get us started, kind of very introductory. Please define cost basis, especially as it pertains to buying stocks.
Yeah, happy to, Aaron. And you're right, indeed, that this notion of cost basis comes up all over the place. And the reason it comes up so much is essentially the government wants to tax us. So they need to know 2 important things. They need to know what you sold something at, that's usually your sell price. And then they also need to know how much you bought that item for. And that's, your purchase price. And they would probably tax you on that difference if there's a gain. Now, very simply, the cost basis is linked to that purchase price, but there's a lot of caveats, and that's where things get a little complicated.
A lot of caveats.
Right. And that's why it's probably going to take an episode or 2 to dig into all the various things that come up, because it's not so easy to just subtract these 2 numbers, your sell price minus the buy price. But at a very high level, the cost basis tries to figure out that buy price and then kind of adjusts it for things that may reflect changes that may need to be made on that buy price.
a very simple change that may need to be made is, let's say you paid some commissions to make that purchase. Well, you don't want, the government says you don't have to pay taxes on that commission. So you can increase your buy price by those commissions, and then effectively you increase your cost basis a little bit. So then after you subtract that value from your purchase price, you may pay a little bit less in taxes because you're accounting for the commissions that you paid. So that's just one example of an adjustment to the buy price that happens with cost basis calculations.
And usually custodians, especially if you have us there, will track most of this for you. They'll track almost everything for you. And so that's why, especially with the commissions, that they'll show kind of an adjusted cost basis. That's a common phrase you'll see on both 1099s and different reporting structures and statements. So that is one of those components. Another thing I think about, I saw this recently, and you'll probably have to go into more of the mechanics of when a mutual fund issues a capital gain or dividend distribution, they're passing out, again, gains or dividends to all the mutual fund holders. And so you actually pay taxes on that dividend or capital gain, even if you haven't sold any shares from the mutual fund. And most of the time people reinvest that mutual fund. So they feel like, well, my value from one day to the next stayed the same because the dividend and capital gain was reinvested, but now I have to pay taxes on this. And one of the ways that gets made up for that is that dividend or capital gain distribution raises your cost basis so that you have, again, if you think of it as a capital gain distribution, if you put in $100,000, it goes up to, say, 110, then the mutual fund issues a capital gain distribution of $5,000 or 5%, or well, it'd be 5,000 divided by 110, so it'd be slightly less, and it's not going to be a nice easy number. I should have made the math easier for myself. But you'll have a capital gain distribution. You'll pay tax on that 5,000, but now your basis is no longer that $100,000 you put into the mutual fund. Your basis has gone up, is now adjusted to $105,000. And the idea is that if you pay the taxes, or if you pay the taxes on your capital gain distribution and then you sell out the next day after that capital gain distribution, you're still selling at 110, kind of the current value of the mutual fund. But now you've paid that first 5,000 as a capital gain distribution that all holders of the mutual fund paid out. The other 5,000 is your kind of your own individual gain, and that those don't have to be the timing. So if the value stays flat for a long enough time frame, it's the same idea of you've already paid taxes on the capital gain distribution. They're not going to double tax you for that first 5,000 of growth, that 100 to 105. I think that's the key here, is that the IRS is trying not to double tax you or tax you for things you're not supposed to pay taxes, and they try to give you the opportunity to show that when I sell the investment, I'm actually raising my cost basis to account for the things I've already paid taxes on, and not paying taxes on those gains, and kind of like having that double counted. And that makes sense when it comes to like a mutual fund and the capital gain distribution.
Yeah, it's a very good point. And you're right. The high level notion is when you have a capital gain distribution or a dividend, typically you do reinvest it. And the math kind of just works similar to how if you took those distributions, you took that money, that check, let's say they mailed it to you, and you placed it right back into that account. Well, what would have happened in that situation is essentially that money, you get a separate 1099 for that, a form where you have to pay taxes on it. So that money has already been taxed. Therefore, if that money goes back into that account, we want to make sure, or the government wants to make sure, that you're not paying taxes on that again. So that's why the adjustment is made to the cost basis. And it certainly is sensible to do that.
That's a great point. That's a really, really good comparison of if the stock goes up, issues a dividend. I'll let you get into the kind of how that affects the stock price. But if you take that dividend and buy the same stock, you've now bought at that higher value. You kind of have that the new basis for those new shares for that smaller amount is at that 110 level. Let's say it's just only one share of stock, one share of IBM went up from 100 to 110. So if you sold a month later and IBM stayed at 110, it would make sense that you still owe taxes on your original investment, the original shares, but that dividend that got reinvested, there was no actual gain in it. So it's you bought it at 110, sold it at 110, and that's trying. All of the other components are trying to account for that same idea that because you paid taxes on the dividends, if that gets reinvested, we're accounting for that. In this case, by raising your overall basis on your investment, but it would be the equivalent of kind of opening up in a new account and tracking each dividend separately.
Yeah. And just, I guess the nuance you are alluding to there with a dividend is essentially when a company pays a dividend, it all gets accounted for such that there is no free lunch here. Like, let's say IBM's trading at $100 and they issue a $2 dividend. Well, then the stock price would drop by $2 to reflect that. Now, you can't make money off of that because the total amount of money in your account is still $100. You have a share that's 98 and you have $2 in cash.
Yeah, so that, yeah, I like that. That's a good explanation. Was when it comes to dividends, we're trying to there's no, like you said, no free lunch. It doesn't matter if you buy the stock right before what's called the ex-dividend date or right after the ex-dividend date. That's the date on which all the shareholders are recorded and to whom they will pay out the dividend. So this kind of, they're trying to, there's no incentive to buy the stock right before or right after the dividend. It's not like, oh, if I buy the stock right before, I'm going to get the stock price plus the dividend, and I'm just going to hold it for 2 days and just collect that dividend as if I own the whole thing for the whole quarter or year. No, that's and kind of you see this if you're really tracking it, assuming all the other financials and economic environment stayed exactly the same and we're just trying to reflect company profitability, you would see IBM go from 100 to 102, and then as soon as they issue a dividend, it goes from 102 back to 100. And the kind of, you can kind of like see that, you would see that reflect for each dividend that they pay out. And the idea is that they are showing that profitability. So kind of by the end of a year's cycle, the stock price is the same if no financials have changed, if the company hasn't grown, hasn't retracted, there's no economic outside influence, all they're doing is paying out the profits to the owners of the company, which is all the shareholders, and they're paying out the profits in the form of a dividend. So you would see that kind of stock price goes up, reflecting if you buy or sell, you've captured a portion of the dividend that you expect to receive. Dividend gets paid out, stock goes back down. And it does play out. Now, again, realistically, there's so many other factors that go into stock prices over time. But because of that function, it doesn't matter if you buy the stock right before or right after the dividend. If we want to get like super picky, technically, you might not want to buy the stock at 102 if you're just going to end up having $100 stock and $2 in cash a few days later. Like it's mildly annoying to, oh, I invested my 102 and I got now I have only 100 but I have $2 in cash. I still wanted to invest 102. I got to put that $2 back in either the same stock or somewhere else. So that might be a reason to kind of be aware of an ex-dividend date if you're buying individual stocks, especially mature companies that are issuing dividends. But realistically, you're not hurt. Everyone is more or less kind of made whole throughout the dividend paying process.
Yeah, the one thing I would add is now you would actually have a little bit less because you owe taxes on that dividend. So
Yes, but you'd owe a little less if
especially
you happen to sell like 2% of your holding the next day.
right. And the other kind of event that happens in these types of situations is stock splits. And in this case, for example, if a stock is trading at $10, well, then after with a 2-to-1 split, it'll drop down to 5. Well, that same type of adjustment needs to happen to your cost basis, because what actually happened here is not a real financial event. It's just a mathematical event. There's nothing that really changed in terms of the ownership of the company or the earnings of the company, or even the ability for the company to grow and produce revenue or anything like that. It's just an accounting feature where the stock price turned into half of what it used to be and the number of shares doubled.
Mm-hmm. So I put in $1,000. So that's kind of my dollar cost basis. And I bought 10 shares of IBM at 100. And so when the number of shares gets doubled, the stock price drops from $100 to 50, which we know could never happen because IBM is always 100. But it now makes sense that I have still $1,000. My total value is still the same. So I now have, instead of 10 shares, I have 20 shares. But my dollar basis, again, there's no dividends at this time, my dollar basis stayed the same. I still put $1,000 in to own 20 shares. So now my per share adjusted basis has gone down to that 50.
Yep. Yeah. And you can imagine that the whole point of this exercise is, again, to get to the amount of gain that you have. And the amount of gain is, now that you have this cost basis that's been adjusted because of these various things that have happened since you've owned this position, including any fees and commissions and dividends and capital gains and splits along the way. Well, when you finally go to sell this position, that sell price is going to be matched or compared against this cost basis to figure out whether you have a gain or a loss.
Yes. So, okay. So I think that's the next segue of, okay, now if we understand basis, what do, I guess the two things that come to mind, well, three things to think about my list. So one, we have the gain or loss component. We also have kind of the lots idea, and especially as it comes to like FIFO and LIFO, so like the default sales. So kind of when we're selling, it is a very realistic that we have, of the same investment, different purchase dates and purchase prices. We have different bases for different lots, and it is not necessarily safe to assume that just selling some shares will automatically get a certain basis. And so when it comes to, if you're only selling a portion, if you've bought some another date, bought a little bit more, had some dividends get reinvested, and you have these different bases, when you sell, you need to know which lots are being sold, because it's going, even though the sales price will be exactly the same across all the lots, the basis is different for each of those, and therefore your capital gain or loss is different. So do you want to give us a quick kind of primer on FIFO and LIFO and lots and some kind of default processes if we're not paying attention to lots and basis?
Yeah, I think to begin, let's just talk about what a lot is, or a tax lot is. The notion is, when you go out and you make a purchase, it typically ends up in chunks of 100 shares. And if it's less than 100, whatever is remaining, like 20, 30 shares. And the reason for that is orders typically go through the market in these round lot numbers of like sets of 100. And when you send an order to the market of, let's say, 500 shares, they may be broken up, or let's pick like 505 shares, it may be broken up into 5 different lots of 100, and then last remaining lot of just 5 shares. Now, each of those lots may have a different price depending on what people are willing to sell at. It may sell for 100 for the first lot, 101 penny for the second, 102 pennies for the third, and so on. And the reason for that is there are orders where people are waiting to buy these 505 shares, but there sometimes people are waiting to buy at only 100 shares at the $100 price, and then another 100 shares at the 101 penny price, and so on. So these orders get matched up in these round numbers of 100, and then usually there's some stragglers that get matched up for any remaining.
You know what? I gotta admit, I was not prepared to have to go into like bid-ask spreads and market makers today, but I think that's a really good point. Because if a lot of the big trades, especially kind of if a mutual fund is looking to buy shares in a company, it's not going to be just 500 shares. It might be 500,000 shares. And so there's no other person on the other side to like, oh yeah, I have $500,000. I'll sell all to you at one price. A lot of market orders, even broken down into those, like you said, 505 shares, 1,000. Those do. There's kind of the market makers are there to kind of provide liquidity market, and they'll kind of list those bid-ask spreads. So if they're looking to buy, like you said, like I am not going to buy at 100, but I will buy at this many shares at 1 penny less, and I'll buy the next amount of shares. And so that's what you actually see if you go into any online reporting of current stock quotes. You'll see that bid-ask spread, and it's kind of if you as a retail investor were able to buy those shares and nothing changed, and you're able to kind of turn around and sell those shares, you would actually lose a couple pennies. It might be on a scale of like 0.1 to 0.2%. So I think I was looking at Apple the other day, or Microsoft. I think it was looking at Microsoft, and the share price is over $200. So the spread was like 20 cents. So you could actually see a 20-cent spread, but it's a function of the share price was over 200 already. But if you, as a regular investor, wanted to buy, you're going to pay their ask price because they're only going to sell to you for those couple pennies more. And if you want to turn around and sell it, you're going to sell up the bid price, because if they're going to kind of provide that liquidity and take that deal and just like have that deal ready for you to happen as fast as possible, they're going to collect the difference on that bid-ask spread. So yes, when you put in a trade of $505 at a market order, even that one all happens on the same date, could even happen with a scale of minutes or even seconds. It is very possible that it gets broken out into different lots with slightly different prices. And again, depending on the if it's $100, might only be a penny, but it could be as much as 10 cents per share. That might be a slight high in a bid-ask spread. So you get into like large cap stocks with a lot of trading volume and a lot of people participating. It's easier to find the other side of the trade really quickly. So bid-ask spreads will be much smaller, but smaller companies and small cap stocks and even smaller, those might have larger bid-ask spreads because it's harder to find the other side of the trade. And so the market makers will say, well, okay, I'll take this, but I need a little bit extra in that bid-ask spread. And so you would call those kind of thinly traded stocks. And so again, if you were trying to place a large order in a thinly traded stock, again, unusual, but it's very possible that the trade itself is moving the stock price. I think we talked about this a while back when we were trying to talk about like the order flow when it came to GameStop and trading. So most people, not going to be an issue, but yes, it's a really good point. Because this process exists, even when you place your buy order, you could have different lots with slightly different bases.
Yeah, indeed. I can even imagine that a lot of this trading stuff might be good for an episode. There's a lot of nuances and a lot of stuff that goes into the actual trading component when it comes to securities.
Okay. Sorry to derail you, but let's get back to, we have lots. They might have different bases, and then we're also talking about like selling those lots, identifying FIFO, LIFO, etc.
Right. So it's easy to understand that when you make a trade for a single security, even over the course of one day, you might have different buy prices associated with even just one trade order that you put into the market. And then, of course, you might not even be buying for that one day. You could be buying over the next week, month, or year, or decade. So now you have all of these different prices that you need to keep track of when it comes time to sell. And the reason this is kind of important is a few things. One, we need to know what's a gain or a loss when you go to sell. And the other thing is we need to know whether that gain or a loss is short term or long term, because the government cares about that as well. So obviously the difference between a gain or loss is if you have a gain, the government's going to tax you. If you have a loss, you can actually offset your gains. So with the short term and long term, that's the difference between paying a long term capital gains rate or having an offset with a long term capital gains loss rate. And the short term is actually, the short term rates are your marginal tax rate in this situation. So the long term rates are far more favorable, and that's what you want to aim for. These are for holdings that are longer than a year. So the government is trying to incentivize people to hold on to their positions and not trade them a couple times a day, like the game stonks fiasco. But the goal here is to incentivize individuals to hold things for at least a year so that the rates you would pay on gains drop considerably. If you're in the highest marginal tax bracket, that would change from something upwards of like 37% down to something like 20% plus perhaps a 3.8% surcharge. So maybe ballpark, it's still in the highest tax bracket. 24% versus 37 is a big difference. If you're making less than 80,000 a year, this could be 0% versus your marginal tax rate of the teens, somewhere in the teens. So that's not a bad thing if you can shift these gains to be a year or longer, but that needs the ability to, again, hold on for a year and to match these gains with the lots that you had in place for longer than a year. And that's where this notion of identifying lots associated with a sale come into play. And there are a handful of metrics that people use to do this. And then that's where the FIFO, LIFO average cost and the specific lots methodology comes into play.
Okay, so do you want to give a quick definition on FIFO and LIFO?
Yeah, so the acronyms stand for, FIFO is first in, first out, meaning the first thing that you purchased would be the first thing that you sell when it comes to a lot. So that means the thing that you've held on to the longest, be what ends up being sold first. So that's what FIFO kind of talks about. And then LIFO is last in, first out. So the thing that you most recently purchased is the thing that gets tied to your recent sale. And the reason these two are used is that there's different benefits to each depending on what happened with the stock since you bought it. And the goal here is for the individual to choose the methodology that would keep their taxes lower depending on what happened.
So I think that's actually a really good distinction, because one of the specific examples, I've done this a few times for clients, is given the custodian who does the trading, identifying lots can become very important, because in your example, if let's say we've been buying stock over the years, for my clients, it's usually either RSUs or stock options, and the kind of, as they keep investing it and the stock keeps going up, okay, in this scenario, it is very likely that our original shares have a large unrealized gain. So kind of it's a gain we have not yet realized. We haven't sold out of it, but if we were to sell, we would owe a lot in taxes based on that larger gain. The more recently purchased shares probably don't have as much gain, just because they were bought at a higher price and haven't had time for the stock to go up. So they have a smaller gain. But like you said, it would be taxed at short-term rates, which is ordinary income. So there are actually many times where we're looking to identify the lots that are at least long-term, so at least held longer than a year, but still the newest, to minimize the taxes on that particular sale in that particular year. So if you understand, again, FIFO, LIFO, long-term, short-term, there are actually a lot of times you're looking for those shares in the middle. You've held them for at least a year, but they have a higher basis than the shares you purchased many, many years ago, and therefore your tax hit in this year would be the lowest. And it's really important that kind of neither default method, FIFO or LIFO, would choose these middle shares to sell. And so it does really come into play as much as possible, depending on your situation, depending on the stock, depending on how many purchases you've made over the years. But identifying those lots when looking to sell becomes really important. And that there's enough times where you don't want to go with either default process.
Yeah, that's a really good point. So with FIFO, LIFO, you also have the ability to choose, like the highest cost or the lowest cost, or pretty much you can even single out individual lots. And that happens to be my preference of choice for the reason you stated, Aaron, because it really depends on the situation you're in. And what we have on, for example, on the institutional side is we have software that runs the numbers and it figures out, for this particular sale, this is what makes the most sense based on the cost basis that the software is seeing. So that there are ways to control this one lever that can help keep taxes under control for a given client beyond just, doing a set it and forget it. So this is certainly something where there is a decision that needs to be made, and making that decision can have real money benefits on your final after-tax return. So it's certainly sensible to think about this before you just go ahead and sell a position, or go ahead and go with the default, or whatever happens to be there in whatever your broker environment that you're using. So realizing that you actually do have the ability to tag individual lots can be important to understand, and then using that ability to actually come up with an efficient way to liquidate a position can make a big impact on how much taxes you ultimately end up paying.
So I think that brings us to our next point, is when we can identify the lots, because stocks don't always go up. They go up and down over time. And when a client calls, not necessarily the company stock side, but they're looking to raise money, and so we're looking to sell it. And we'll try to consider. This is like why I love comprehensive financial planning. It's not a safe assumption we always want to reduce taxes, but there are times where I've had a client situation, they're trying to keep their earned income under a certain threshold so they still qualify for the Obamacare subsidy. So they need somebody to live off of, but we actually just can't raise their taxes this calendar year. We can't raise their income too much. And so when they need to raise money, one of the things I would go is look at the lots and actually look at which holdings have lots that are currently at a loss. Because even though it's very likely that just having been invested for years, most of the portfolio is up, it is possible to find both different asset classes and individual lots within those asset classes that have either little gain or have a loss. And so I'll try to raise money for them in that particular year if we're trying to control their income, and look for the lots with a loss first, and then we'll use that to offset other lots with a gain. So it's possible, again, depending on the size of the account, how much money they're trying to raise, and how long it's been invested, and market volatility, et cetera, that we could sell out of a diversified portfolio without taking too much of a tax hit. And now again, you can only do this so many times, because if you sell the lots that are a loss and you sell the lots that have a small gain that will be offset by those losses, eventually kind of you're only left with the lots that have a pretty big gain. So eventually you do have to pay the taxes, but it's the idea that you get to control that. You might wait until there's a year in the future where you don't have as much earned income and choose to realize your gains then. So I'll take the time now, kind of start thinking about if we understand we can choose which lots we sell, and we are aware of FIFO and LIFO, but we'll choose the lots we want. We're now looking to be opportunistic with both gains and losses, whether it's kind of now or in the future. What are some of the things you help your clients with again, just looking at if we know which shares have their cost basis, and we've trust a custodian has been capturing the stock splits and the dividends, and have good cost basis information. What are some ways you take advantage of that with selling for gains or losses?
Well, another big one, it's kind of implied in the name, is tax loss harvesting. So what you're doing there is you're looking for these losses opportunistically on a lot by lot basis to understand that if you have these losses, you may be able to sell those instruments and book those losses, and then buy a similar instrument, being quite careful to avoid any wash sale considerations, because you can't buy the same thing again the moment you sell it. The government imposes a 30-day window on that, but you can buy something similar. In which case,
really quick, I want to the wash sale. What this is saying is that if you were to sell IBM at a loss, they turn around and immediately buy IBM right back within that 30-day window. The IRS just says you're keeping your original basis. So it's you're not necessarily penalized per se. It's just that the loss you're hoping to capture on that sale is disallowed, and so your new purchase isn't you don't get the basis of what you actually paid. You're keeping the basis from the first trade. So that's why we talk about wash sale considerations. We want to avoid that, because if we're looking to loss harvest, we want to realize the loss. We don't want the loss to be disallowed.
Yeah, and what you can do in these situations is you can realize that loss, but buy not IBM again, but buy something similar, like Apple. Or in this case, if you're harvesting a loss on a ETF that tries to track the broad U.S. market, well, you can do something that tries to do something similar, but that is not exactly the same. And what this allows you to do over time is to, again, capture these losses and use them to offset future gains.
Yeah, my best example is we've been investing in our taxable investment account. That's a good caveat. All of this applies to taxable investment accounts, almost nothing to retirement accounts, except for company stock and a 401k. I don't know if we'll get to that, but maybe. So in the taxable investment account, if you've been investing $1,000 every month as a kind of good savings, and you do that for a long enough time, you've been investing in the S&P 500 ETF. You can sell the S&P 500 ETF, buy a Russell 1000 ETF, which is another US large cap index. And those are realistically going to be so similar that your performance and your risk and your expected return are going to be almost identical, but they're different enough that they would not violate the wash sale rule. So that's usually my example.
Yeah, and the great part now is, again, that on the institutional side, there's software that helps us do this across client accounts, where we basically run the software and it tells us, here are the different losses that we see across these various holdings for a given client's portfolio. And here are the short-term and long-term potential gains, and here's what we can do to offset them. And then, we instruct the software to say, okay, here are the substitutes to buy, and it goes off and does it. So it's something that if you have the ability to kind of opportunistically take advantage of this, it's like something that it certainly is sensible to do.
Yeah, I think it's a good point. Is that the loss harvesting kind of has to be done when the losses are available. So kind of because of just volatility in the market and different investments, if it's keep going up, there may not be losses that you can harvest. So you need to be. This is a way to take advantage of downturns in investment. So in 2008, 2009, I did a lot of work with my former firm of generating significant losses on behalf of clients. Same thing, we'd sell out of one large cap, move to a different large cap, sell out of a small cap, move to a different small cap. Same thing in March of 2020. Look to that was the time when some of these investments were down enough that they would have losses. We have to harvest those losses at that time, because if you wait, in this case, a month or two, the losses are gone. You don't have that opportunity. The big benefit is that losses, first they'll offset gains on your tax return, but if you even don't have that many gains, you'll use losses to offset $3,000 of ordinary income. But then any losses that don't get used to offset gains or offset ordinary income by $3,000, you get to carry forward. You get to carry forward that loss into future years. So loss harvesting is one of those things where you have to have the market downturn. You harvest the loss then, even though you don't know when you'll be able to use that to offset gains in the future. And so some clients generated losses in 2008, 2009, and some of these numbers were pretty big because there's such a huge downturn and so many things were down. We harvested a lot of losses. They were able to offset gains for almost the next decade. I think for some clients on a scale of 6 to 9 years, where they didn't have to pay taxes on any other gains because they had harvested those losses in 2008. And that's usually what kind of good financial planners will be looking out for. It's not going to be kind of generating that alpha, but by paying attention regularly, again, I'm not going to outperform the index, but when something's down, I can harvest a loss. That's going to help you for years to come. And so it's the loss harvesting opportunity is not always there, but when it is, you have to take advantage of it, because you don't lose those losses. There's almost no reason not to harvest the losses because they will carry forward.
Yeah, good points, Aaron. And I think another case where this comes up is just an annual rebalancing, or whatever frequency you are rebalancing a portfolio. The notion here is, let's say you're trying to keep a portfolio within the guardrails of, let's say, 60% bonds, 40% stocks. Well, in that case, if that becomes out of line and all of a sudden you find yourself 50% stocks, 50% bonds, well, now you want to bring yourself in line, so you need to sell some of one and buy some of the other. And to do that, you may want to do it opportunistically on a tax lot basis.
That's a great point. I think that comes up a lot, where going back to my example of the client who's trying to raise some money without incurring too much gain in this year, is a very realistic risk. So it happens a lot if you have a 60-40, 80-20 portfolio where the stocks are up, and so there's going to be gain, but the bonds are flat or might have a small loss depending on interest rate changes, because especially if we're using muni bonds, they're getting interest income that'll be tax-free to them. If it's muni, it will be taxable if it's a corporate, but for taxable accounts, I use munis predominantly. So the basis of the bond might be flat, so there's very minimal gain. And so now we kind of have a conversation with the client of, we can raise the money without increasing your income for the year by selling the bond side. But now that means that you're holding on to all the stocks and your portfolio has gotten riskier. And this is a pretty consistent, difficult conversation. Are we willing to take on the additional risk to be able to raise money without increasing your taxes? Or is it more important to maintain the same risk level and take the tax hit? Kind of, we're choosing investment risk is more important than saving on taxes this year. And it actually comes up with rebalancing pretty consistently. A true rebalancing program in a taxable account, if kind of stocks keep going up and bonds stay flat, or they just generate income that probably gets reinvested, if you do rebalancing, you're kind of consistently selling the stock side and buying the bond side. You're consistently managing your risk. And so we kind of, like you said, we're staying within those guardrails. We're not getting too risky, because that is a bigger, kind of more important part to your lifestyle. Kind of, if you get overweight on the equity side and there's a downturn, you are hurt more. But it probably does increase your taxes a little bit each year than just buying and holding. And so it's a classic conversation that comes up a lot when I'm talking to clients about stock options. There could be an optimal investment strategy and an optimal tax strategy, but they might be on opposite ends of a spectrum, and we have to decide where on that spectrum it makes sense for you, but this particular calendar year and in general. So there might be times where, no, we need to make the optimal tax decision this year, but come January, we can then get back in line with our ideal allocation. So you can wait that calendar year before making those changes. That's a pretty common scenario where we need the money, we do it without raising taxes, but come January, then we will kind of get back in line with your ideal portfolio. So that does come up. Those are some hard decisions of investment risk versus optimal taxes. And that's a great point about rebalancing.
Good stuff, Aaron.
I think one last thing I want to add for today. You'll see this sometimes with custodians, especially if you've been buying stocks for a long time, is covered versus non-covered when it comes to basis. Covered, it means that the custodian has reported the cost basis to you and the IRS. Non-covered means that they are not required to report the basis to the IRS. The basis is only information sent to you. So if you bought something in general before 2011, that's when kind of some of the tax law changes, and IRS and Congress started requiring custodians to report cost basis on behalf of their clients. And they also started tracking significantly more effectively since 2011. If you happen to own something before 2011 and then you sell it, it is a very realistic possibility the custodian does not report the basis to the IRS. It is your responsibility on your tax return to say, this transaction, because the custodian does report the transaction, they report the sale. And the IRS, if you don't say anything, will assume that entire sale is capital gains, that you had no your basis was zero. So you have to report to the IRS that, no, this is my basis, and your CPA or tax preparer will help you, and you kind of, if you're audited, you have to show where that basis comes from. And so you can make that line up on your tax return. And that's actually one of the ways that I try to check the cost basis on behalf of my clients. When it comes to tax returns, making sure that that basis information is reported correctly. This is also kind of a story I've gotten from CPAs. So I've never done this, but I kind of know of CPAs who have done this. For clients who've worked at a company for a long time and have dividend reinvestment programs, and or they bought stock or they inherited stock a long time ago and they literally don't know what the basis is, the IRS, if they don't say anything, will say your basis is zero, the entire thing is capital gain. But they will apply some common sense and kind of conversations via mail between CPAs and the IRS will kind of say, well, no, I know it was purchased sometime between 2000 and 2005. And because these are publicly traded companies, I know the lowest stock price in that entire period was $40. I'd like to report a $40 basis instead of a $0 basis. And the IRS will kind of accept these arguments. And again, it's in that gray area of you don't have proof, but you can make the argument if you do get audited. And so to accept that. There's also times where if you can get more accurate or more narrow time frame of when the stock may have been purchased, they'll accept that as well. There are certain companies, technologies where if you know that you owned a certain number of shares at some time, so you know like an original basis, and then this company has various spin-offs. So the classic one was HP. They've spun off, I think, 5 different companies. So I had clients who worked at HP going back to late 80s, early 90s. And so they didn't touch their HP stock, but it kept having dividends reinvested and stock in these new companies that kept getting spun off. And so there was a service like we entered the original ownership percentage, and just like the stock split, when there's a spin-off and you now own 2 stocks in 2 different companies, your basis gets split proportionately across the details of that spin-off. And so that can get really complex, but there's services that'll help you figure that out. But I think just that, like, understanding covered basis, especially since 2011, we're going to have much better information. Older than 2011, we can start to make better arguments and start to kind of say, while we don't know exactly what the basis is, we are reasonably confident it's at least this number. And the IRS will accept it because kind of if you give a low enough number that's reasonable, they'll say, okay, yes, we're going to say if you sold IBM at $100, your basis was $40, you only have to pay $60 in gain. Technically, it might have been like a basis in the 50 to 60 range. So the IRS is okay with you overpaying what is likely instead of paying $100 in gain per share. So
yeah, that's a very good point.
So anything else you can think of when it comes to basis and stocks?
I think we did cover a lot of ground there, and you can kind of see why this can get a little hairy depending on all the things that go into this, and the fact that a transaction isn't something that happens in one instant, but it's something that begins when you purchase it and can end, when you sell it, and those 2 dates can be quite far apart. And I think the key thing to watch out for is these kind of inflection points where if the money changes from, like you said, the ownership structure of a company to another company, if there's a merger, or also if money is moving from one broker to another, you want to kind of ensure that that cost basis information gets transferred over. For example, if I bring on an account from a client that's at another broker, we don't sell the shares. We transfer the shares directly using an electronic transfer, meaning we can transfer that cost basis from the original purchase at the original broker to this firm. But we want to make sure that those transfers go through smoothly. And we get those cost basis information fed into the system of, for example, the broker I would use with my firm. And making sure that there's this paper trail is certainly sensible. And I in fact, did have an issue last year, Aaron, with a client where, there were a handful of lots that were from a transaction 10, 15 years ago for a client where that cost basis information wasn't passed over. And this was from a pretty big broker. But as you said, pre 2011, things weren't tracked as nicely as they are these days. And so what the client had to do we teamed up with a CPA, and we actually ended up looking for that price information and did a little bit of forensics to kind of narrow down what the price could have been depending on the date that lot was potentially purchased. We didn't even have that date, but we had a date of, a previous sale and a previous purchase and a previous sale and a previous purchase after that lot. So we kind of, again, had to take a microscope to it, but it's something that you want to get fix. Otherwise, you'll just end up paying taxes on all of it when you make a sale.
Yeah, that's it's accounting forensics or forensic accounting. But yeah, I've done that digging before, and it's like, okay, I'm pretty sure, like you said, I'm reasonably confident it's somewhere in this range. Like, will you accept the lower end of the range? Like, puts the client at the worst end of that range, but it's a lot better than the basis of zero.
Right.
Man, I'm looking at a list of things we were planning on talking about. We still have a lot to go. I think we'll definitely have to do a second half of this episode on cost basis.
Well, thanks everybody for listening. And if you're enjoying these episodes, do spread the word.
Thanks. Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.